I think we're in the early stages of heading towards probably one of the biggest recessions of most people's lifetimes. This is global. It's already the case in Europe. We already have negative PMIs and negative retail sales, and they're still tightening. They might be done. Pretty much the case in China, as much as you can believe all the data. But China also helped spark it by the unlimited friendship right before the war, and now their best customers are heading towards recession. The US, it's a matter of time. Our Bloomberg economics team thinks it's going to start by the end of the year. Yes, they've been early. I've been early on most of my calls, but everything's starting to tilt that way.
Welcome back to Soar Financially, everybody, where we discuss the macro to understand the micro. My name's Kai Hoffman. I'm the @JRMiney guy on Twitter and the CEO of the Soar Financial Group. Truly appreciate you joining us here for this discussion with Mike McGlone. He's a senior macro strategist over at Bloomberg Intelligence, and it's a discussion I've been looking forward to for a while. We've had this in the books for a while, and I've been reading his macro and commodity outlooks for quite a while. People send them to me nicely enough, and it's always great insight. So I'm really excited to talk to the brain behind the document and to get the input. Lots happening in the world that we need to catch up on, because the last commodity outlook that I had available was from the end of September, and we all know a lot has happened in the last 2 weeks, especially over the last weekend. I think we need to put that into context and how it fits into the overall macro thesis that Mike sort of portrays in his commodity outlook. Before I switch over to my guest, hit the subscribe button so we can bring guests like Mike back on the program more regularly, maybe, or guests of other great caliber as well. It helps us engage with us. What do you think of the conversation? Leave that below. Thank you so much. Now, Mike, it is great to welcome you on the program. It's good to see you. Thanks for making the time.
Well, thank you, Kai. It's my pleasure to be on. It's my pleasure to meet you. And I think we mentioned before we really dig in, just for me to quickly give the quick overview is, in terms of the macro, I think we're in the early stages of heading towards probably one of the biggest recessions of most people's lifetimes. This is global. It's already the case in Europe. We already have negative PMIs and negative retail sales, and they're still tightening. They might be done. Pretty much the case in China, as much as you can believe all the data. But China also helped spark it by the unlimited friendship right before the war, and now their best customers are heading towards recession. The US, it's a matter of time. Our Bloomberg economics team thinks it's going to start by the end of the year. Yes, they've been early. I've been early on most of my calls, but everything's starting to tilt that way. And so I'll kind of give you the brief overview. I think what's happened in the last few weeks with crude oil, I think peaked around $95 a barrel. That 30-year yield probably peaked around 5%. I think the stock market has probably peaked, and it's going to head down from a normal recession, and virtually all risk assets should head lower. And if I'm right about this, Bitcoin should be one of the leading risk assets. It wasn't a way up, it wasn't way down. I think gold's going to come out ahead, and everything else is probably going to suffer by the wayside, with the exception of probably U.S. Treasury long bonds. So I hope that's an okay, wonderful way to start. But it's just, that's one thing I'll end with. This is at Bloomberg Intelligence. These are my views, and they're not distorted by a house view or other colleagues. They help hone my views, but I don't have positions, and that's one thing I enjoy about being in Bloomberg Intelligence.
Fantastic. No, I appreciate you clarifying that. Really good summary to start us off, because, again, there's lots to follow up in there. And I think we need to start with recent events and how that sort of fits in, because I think there's for lack of a term, whole rat tail sort of attached to it in terms of macro and geopolitical issues. If you want to frame sort of the events of last weekend, meaning Hamas attacking Israel and Israel now retaliating by attacking the Gaza Strip there, how does that fit into your thesis, and has that changed anything?
It's tragic. We all know that it's horrible. I do have a son in harm's way. I don't want to have to get into details, and from a macroeconomics point, I think it's accelerating the tilt towards a global recession. And let's look at what's happened with copper since it's happened. Copper's broken down close to new lows in the year. It's been one of my key indicators this year. Industrial metals, the Bloomberg Industrial Metals down about 15%. They're showing global recession. Copper at $3.57 a pound is breaking down towards new lows in the year. I think that's going to $3. But what the invasion did is it sparked more fears of now we have the second major hot war going on. We have a Cold War going on. And it sparked fears of cutbacks of supply from Iran. So initially we had that bounce in crude oil, but as the time we speak, crude oil WTI at $82.50 per barrel is below the price it was before the invasion. So to me, that's indicative. I think crude oil is going to 40 for normal recession. And this invasion, this conflict is on the back of what's happening in Europe. And we're finding out that the pump in liquidity, the pump in commodities on the back of liquidity we got last year was somewhat historic. And it's going to do what pumps in liquidity and pumps in commodities always do in history. They're their own worst cure. Crude oil is a wrecking ball. I think everything's going to head down and do kind of what natural gas did. U.S. natural gas peaked around 10 last year, and the bottom this year was 2. So to me, this is part of that global macro reset kicking in. And typically at this stage, you would expect significant amount of monetary easing to help prevent it. The only country that's really easing aggressively is China, because they know the issues, the risks, and they're just kind of ignore what they say, watch what they do. The U.S. is probably done tightening, yet we still have some tightening price in the system. The ECB is probably done tightening, but I think the biggest risk here now is the final shoe to drop is the U.S. stock market has to go down, or the Fed's not going to ease, or bond yields won't go lower, or the dollar won't go down. It's kind of a lose-lose for risk assets. And the key thing I'm watching is U.S. stock market indicators for that. And the key things also, and that's already pointed out, industrial metals has told me the stock market's going down. This pump in crude oil and pump in bond yields right before that invasion was in somewhat akin to 1987, right before the stock market crashed. Bond yields pumped and then dumped. And crude oil pumped in 2008, right before the big global financial crisis kicked in. So to me, this is all happening. The key question I ask myself, guys, what's going to stop it? Typically, it takes an elongated period after the first Federal Reserve ease for risk assets like the stock market to bottom, and that's not even started. And like I said, our Bloomberg economics model is for the U.S. recession to really start by the end of this year.
Again, lots to follow up on. I'm trying to figure out where to take this conversation now, because I want to talk more reasons for accelerating reasons to head into recession. I think there are plenty, but also I want to discuss what could stop it or slow it down. You mentioned monetary policies in terms of easing, but I think we're going to start with China before we get to the monetary side in the U.S. in particular. But I want to talk about the real estate market in China. I think you mentioned it as well. That it's in massive trouble. Evergrande is dominating the news yet again. There's talks and rumors about it being liquidated, bonds being liquidated. Can you talk to us about that and how that might be fuel to the recessionary fire here?
Let's start with some outlooks and facts. Bloomberg intelligence estimates the amount of property in China that's at risk as at default is close to 12% of GDP. JP Morgan estimated total debt to GDP in China is running 280, almost 300%. Different ways to measure. It's harder to measure. I view China as some combination of what I read in Atlas Shrugged, the book by Ayn Rand, and peak Japan and peak Soviet Union about 30 years ago. And I had this view for 10 years, and it's just starting to kick in. And it's been now the main consensus on it. It's just an overdue reversion of a rapidly expanding emerging market. Not profound. That always has happened in history. Look at the US as an example. A good example was Japan pumped up too fast. They got up to about a $4 trillion GDP, peaked around 1989. The Nikkei's never got above that level and still around 4 trillion GDP. China pumped up to 4 trillion around 2010, surpassed Japan. Now it's up to around almost 20 trillion. I think it's just going to revert a little bit like all emerging markets do, and way overdue, but it's historic, the pattern here. The book, The Great Rupture by Victor Shevitz has a great chapter on how China has a history of reverting back. President Xi is completely reverting China back to an inward market, pushing back in free market capitalism, pushing back in people like Jack Ma and embracing people like Vladimir Putin. The whole world gets it. There's a complete consensus in the US. I can't speak as much for Europe. They're best customers, US and Europe, to GMTFO, get me the heck out of China any way possible, and reshoring and nearshoring. Total imports, US imports from Mexico now are well above China for the first time in 20 years. And it's just a train just getting started. So I work for Japanese firms. I was in the trading pits in the 80s when they peaked. Nikkei peaked, and I saw that. And I still see it with a lot of my Japanese friends and colleagues. And to me, it's just happening in China. Demographics are unfavorable, timing's unfavorable, the war is unfavorable. It's classic historic. And I'll end with this. One of the first signals was in, I think it was 2015 when President Xi banned Winnie the Pooh. I mean, you got the sense things are going wrong. So it's just classic example of an autocratic leader becoming very somewhat paranoid, and the best of this massive economic growth machine just reverting. It's overdue for some reversion, but it's happening in a global context. So here's a key thing I'll point out. Total 2-year rates in China, around 2%. They're about almost 300 basis points below that of the US. That's the biggest, widest spread since 2006 or 7. The yuan was around 8 to the dollar. Right now it's around 7.3. I think it's heading there. I mean, China and Japan both have to support their currencies because that giant wrecking ball, the US interest rates in dollar, is only getting stronger. I mean, rates are just too high in this country, and I think it's part of the wrecking ball for all risk assets. And US 2-year note yield at 5.06 as we speak. You guaranteed 10% 2-year notes is the highest we've had in almost 20 years.
Yeah, interesting. Like you keep bringing up Japan as well. Like I'm trying to figure out how to get Japan into that discussion because I'm looking at debt to GDP ratios, and I brought that up in other conversations as well. How that can be also a leading model, or not a leading model, maybe an example, not a good one for where the U.S. might go as well in terms of debt and borrowing from itself, right? But I want to stay on the China topic for one more second. It's more of the capital exposure of Western nations to China and what that could mean if, for example, an Evergrande collapses in historic fashion here. That's $300 billion and probably more of exposure. Is that like sort of the last drop that fills up the bucket? And so.
I think it's a trade and force. Maybe it's a Lehman, but the macro is so overwhelmingly favorable to some mean reversion in China that what is the property crisis ratio of cost per apartment in Beijing is 10 times what it is in New York? I don't remember the exact statistics. It doesn't matter. It's just similar to what we've all experienced. And maybe the Chinese government can protect it, but they're not going to be able to revive their exports as US and Europe go into recession. And both countries are doing everything they can to get away. Remember, there's things like laser with printers now. You can print gadgets they used to buy from China. The world has changed, and the world is moving away. So I do bring up Japan because just look at the yen. It's pushing 150. By the time this hits the tape, it might be above 150, and the yen's collapsing. They're having to support their currencies because they're wrecking ball of the dollar. And the number one factor to make the US dollar go down is US rates and the US stock market going lower. That's a lose-lose for all risk assets globally. But I have to bring up the yen because people have been calling this for a year. The yen's collapsing. the yuan is collapsing. These are the top 2 countries in the world. Then we have the euro with Germany. Germany's in recession. Those are the top 4 countries in the world. And the only one that's expanding right now is the US. And the US is breaking things by having the Fed funds upper bound at 5.5%. There's no reason to touch risk assets in that environment. Here's the background. The background to me is the historic time frame we've had of zero interest rates. It's never happened in the world since 2008 in this country, and Japan and much earlier, is reverting rapidly. The facts have changed. So when interest rates are zero, near zero, people take a lot of risk. They extend on the curve. I like to point out the S&P 500 got the most expensive since 1936 relative to GDP. And now the interest rates are high. We're just reverting those risk assets. And to me, this is just the early days. And the key question is what stops it. Typically takes aggressive Fed easing. Now, that's the issue that's happened in this country. We've had massive fiscal stimulus. We pumped up the deficit this year up to about 8.6% on a one-year basis. We've never done that in the case of a war without a recession, except for a war without a recession. So here's the thing. There's all this fiscal stimulus is incentivizing more monetary monetary restraint. And the number one thing in markets is liquidity. And the liquidity is still negative. M2 money supply is still negative in this country. And like I said, I don't think this liquidity comes back from the Fed. And it's never going to, I don't think they're ever going to ease like the ease they have in the past because the inflation they created until stock market goes down, which is the leading indicator. Most other markets have, like I said, industrial metals have already kicked lower. Copper's already kicked lower. So here's one little thing I'll end with. You take the dollar per pound price of copper. Right now, it's at $3.57. By the time we hit the tape, it might be a little different. And if you take the S&P 500, divide by 1,000, it's basically been about the same price since 2015. And S&P 500 is expensive right now. Right now it's around 4,300. It should be 3,500. Matter of time. Again, and similar measure. If you take the S&P 500 divided by U.S. GDP in trillions of dollars, that's right, 27 or so. Just take those trillions, add 2 zeros, so multiply by 100. That's been, basically the Warren Buffett model. That's been a good cat and mouse indicator for the value of the S&P 500 since 1928. And just recently it got the most expensive, this is the measure I'm using, since 1936, and it's just coming back. So I think that's what the key thing is. I don't want to go back to stock market too much, but it got so expensive. People don't realize yet, I don't think most people realize that yet, the world has changed and there is an alternative, and that is that U.S. government, be giving you 5% or guaranteeing 10% in 2 years.
Interesting. Yeah, let's talk about the Fed a little bit and the tools they have available. On another discussion, I think just yesterday, I was asking my guest as well whether Powell and the Fed have created a big enough cushion to sort of soften a recessionary blow here, meaning they have 5.25% to 5.5% Fed's fund rate. If they lower that and maybe start a bit of quantitative easing, is that enough of a cushion? And that 5.5% or 5.25% potential drop back to zero or even negative rates, is that enough to stop the world or to stop the world from stopping?
Thing is, the base is so high now. I pointed out the highest base ever. If you take just the U.S. S&P 500 divided by GDP, the highest in 90 years. The base for things like inflation in this country use CPI. CPI owners equivalent rents based on the biggest portion of CPI based on the average home price. And the average home price jumped up from around 200 to just over around 400 in about 10 years. That base is so high. So it's the base effect that probably makes severe deflation kick in. And that's been my base case. It's clearly been happening in commodities. The price of crude oil, right now on the screen, $82 a barrel, was first traded in 2007. That's magic. We said that about stock market. The average price of crude oil this year is $77 a barrel, WTI. Most people thought a one handle would be in front of that last year. That's part of the deflation picking in commodities. Gold is the one commodity that is actually, the average price has actually made a new high this year. It's around $19 and $1,930 per dollar. Now, in other currencies, it's made new highs. But to me, this is part of what's happening is never forget where you're from. And it's what we did in the last few years by pumping massive liquidity in the market. The big inflation, we had PPI jump to the highest ever in the US. Now it's dropped at the greatest pace ever. The low this year for PPI is minus 3.1%. But we punched so much money into the system, we're still taking it away, and we're early days of heading towards this global recession. Like I said, it's already kind of the case, definitely the case in Europe. China's somewhat dicey, but you see what they're doing with their rates. The US, it's a matter of time. Just look at leading indicators. They're negative 7.6. We've never had leading indicators that low on a year-over-year basis without a recession. And there's nothing to save us yet. So to think about getting out of this. Oh, and here's part of this unemployment. People point out the backward-looking unemployment number. It's bottoming from its lowest level ever. And every time it does that and the curve's inverted, we've had severe recessions. It's happening that way. So the question is, again, there's nothing right now to stop these bodies in motion. And that usually takes Federal Reserve ease. Now, I say the Fed because most central banks need ease, but we've already had some easing starting in Brazil, some other countries. They are doing a massive exporter of grains, which is part of the deflationary bent. But I don't know where we want to end with this, except maybe I'll just point out some facts. I'll point out one fact of deflation. The most significant measure of U.S. heat, electricity, and fertilizer. Natural gas last year pumped up to $8 per MMBTU. This year's low is $2. That was first traded in 1990.
Oh, okay. There's a massive drop, and we're not seeing that really reflected though yet.
So you are in anhydrous ammonia. You're right. It's one off. It's bounced up to about 3 right now. It's got the winter kicking in, but it is a key part of it. It showed up very much in fertilizer for farmers. Corn fertilizer. Farmers are making a killing. Corn has dropped a third this year. Soybeans have dropped a third this year, partly because they just got pumped too much last year. But it's the lessons from that great Canadian Jeff Booth. He wrote in his book, The Price of Tomorrow. Is technology is moving so fast now. I can point out certain facts about U.S. liquid fuel and crude oil production have increased 100% in the last 10 years, yet rig counts are the same. Total yield per acre of corn in this country has doubled over the last 50 years. From 1 acre, you can double the amount of corn. It's just technology and things kicking in. But the key thing in the macro is I'm more worried, which is a lot of that means metals should do okay, metal and like copper and gold. But I'm more worried right now about the big picture macro, this way overdue reversion in the equity market that got so expensive in a zero interest rate world, and the facts have flipped. 5%, 5.5% Fed funds is bad for risk assets that got used to 0%.
Absolutely. And I think we're seeing that as well. Like commercial real estate, mortgage rates at right around 8%, I think 7.8% as of late. Extremely high. And we're seeing less mortgage applications, things like that. Mike, one thing I want to talk about as well is like the timing of the recession, because a lot of commentators I had on the program here in the last 12 months said, well, we should have already been in a recession based on their timings and based on their comments. We're almost out. We should almost be out of it already. But where is it? Like, I know it's tough to forecast, but what's sort of delaying the inevitable? Are there particular reasons for it?
Oh yeah, well, there's some good. First, raise my hand. Been early, been wrong. I got a few things right, and we'll focus on what I got wrong. I was too early on that. The recession too. Our economics team thinks by year end. Their model for 1 year kicked in over a year ago. But what's really changed is this massive fiscal stimulus in the U.S. Some people estimated around $3 trillion. You can see it in the budget deficit jumping up to around 8.6%. Just this year. That's never happened without a recession or a war. Never. I mean, of course, my data only goes back to around 1950. And you know what happened during World War II. But that fiscal stimulus was offset by monetary restraint. That's a big problem. And there's a residual effect of the biggest pump in liquidity in history, bar none. I mean, our government and some others wrote checks to people. Some of that money's still left over, and a lot of it's going fast. Now, we've estimated that the amount of money cash on hand from Bloomberg Economics for people is declining rapidly. Bank credit is declining rapidly. Bank credit is actually negative. These are all signs of early recession. What you see every day on the tape about strikes. I mean, it's classic end of period cycle stuff. And it's not US, it's global. So this kind of thing is just early days, but it's also, it's trying to be specific with the historic aspects of what just happened. Paradigm shifts aren't that easy to identify. I've been early, I've been wrong, but I do expect the S&P 500 to go to about 3,000. Normal correction in a normal recession. I don't think it's going to be a normal recession because we're so way overdue for just kicking back. But it was the end of that period where the Fed put was always there to save you. So I went back to 1915. Every single time the S&P 500 went down on about 20% or more on a 12-month basis, always the Fed was there to cut rates and started cutting rates. There's only one example where they didn't. It was 1988 because we already had the stock market crash. So it was the base measure. This time it's different. The Fed is clearly pointed out this is time to cut that umbilical cord where the market's just dependent on them every time they cut rates. And my colleague Irie Jersey has been spot on with the Fed. He says the Fed put strike is much lower than it used to be. So that's what the market has to start learning. It's not there for them. And this is part of the reason I think we're going to be in that great reset. So where has that already started to happen? You can clearly see industrial metals down almost 15% this year, despite the S&P 500 up about 15%. Now, that's a Bloomberg Industrial Metals Index. Copper's leaking lower. I mentioned natural gas, the inverted curve, one of the best indicators. And then, of course, U.S. leading indicators have been negative all year. And that's been consistent for 100 years for U.S. recession.
Interesting. Yeah, I appreciate you summarizing that because everybody's like been like for a week or so, even on Bloomberg, I think everybody was talking about the Godot recession, like the movie. Everybody's waiting for Godot. I keep butchering that name. It's French, I think, and I'm slaughtering it, but I apologize for that. But you catch my drift. You catch what I'm saying. Everybody's waiting for it. It's not coming, right? So that's something we need to keep in mind. I appreciate you like let's call them hidden stimulus packages because we've got the Inflation Reduction Act, we got the CHIPS Act, things like that. But it's not officially called like recessionary stoppage spending. I don't know. I'm missing a word here, but you catch my idea.
Well, here's a little hint on that. We used to call it the Strategic Petroleum Reserve. People called it the Strategic Midterm Reserve when President Biden released it. But we can go there. I just want to hint on that because there's some truth to it, but it was also, I think, one of the best crude oil trades in history. It's just the essence of backwardation. When you have that steep backwardation, the number one thing about inventory management, you just sell some of the spot at a really high price, buy back some of the futures right away. You can at the back futures, you can, they're at 20% discount for a while. And you've got the same position on paper, and you just made 20%. So I think that that was part of it. And this is part of it, but then we do an election coming up next year, and we have a split government now. Now we have, since the midterms, the House has gone Republican, so it's not going to be as easy to stimulate. But they already have. That's the point I make about OPEC. People say, well, why isn't crude oil going up? I said, well, OPEC's already cut. I mean, they've already prepared for this. It's they've already had the bounce from the cut, which means it's going to make the drop much harder.
Well, glad you brought OPEC up on the oil price, because I wrote down I need to ask you about crude prices and OPEC Plus and the $40 price target you mentioned, whether Saudi Arabia and the other nations would allow that to happen.
Well, they can't do much about it. They already been cut, and they don't control it anymore. So by the time this hits the tape, I'll have published my outlook, crude oil facts and fantasies. I updated the version from last year. And OPEC is right now about 28% of global crude oil production. Back in 2008, they were about 40%. You see the trend there? Yeah. I'm now facts. The number one factor that's really pressured crude oil since 2008 is U.S. and Canada, the excess of U.S. Canada liquid fuel, crude oil. Liquid fuel means biofuels and other things, excess of production over consumption. So I like this metric that I just started using. If you take that excess, it's around 6 million barrels a day. Right before, around 2008, it was a deficit. And had to import around 10 million barrels a day. So now there's an issue. You got to export. If you don't, if we cut off exports, that 6 million barrels a day will fill up what was sold out of the SPR in maybe 60 or 70 days. So that's the difference of the world. When I was pumping gas in 1979 in Chicago, and we had to price gas in half gallons because it went over $1 a gallon. But in that metric, I added excess of the number one factor pressuring crude oil prices. Then I added OPEC's surplus. Now, because OPEC's cutting back, they got a pretty good surplus picking up. Right now, that excess of U.S. Liquid fuel, U.S. and Canada liquid fuel production over consumption, plus OPEC surplus is running around 12% of global production. To put that in context, that's a surplus. The deficit in 2008 was 10%, about that. That's called a paradigm shift. That's a pressure for crude oil to do what it almost always has. When it pumps with the velocity of last year, it dumps, and has a tendency to make, since then, it's made lower highs and lower lows, and each low's been around 40. So a typical recession, I think it gets down around $40 a barrel WTI. I've been early, I've been wrong, but I do like to point out the average price this year was 77. The low is $63.64. A year ago, most people thought there'd be a one handle in front of that.
Absolutely, yeah. The $140 target, I heard a lot. Not 150, but I think it was 140. So, but I do have another question. I'm not sure if you've followed the Exxon Pioneer deal. I do have one question that just popped into mind, and whether they've published or so an oil price case that they're basing their calculations on for the takeover. Just curious if you have an idea on that. We can skip over that.
I don't follow the equities as much. Yeah,
just curious about base case and long-term planning, because spending $60 billion, you got to have something in mind. You got to have some Excel sheet that has a certain model in it, right?
So, yeah. Well, so let's point out facts. The average break-even cost of production in the U.S. for a barrel of crude oil, based on all the data on a terminal, from 6 average sources, is about $60 a barrel. It got as low as 50. The data, as far as we go back in the data, it was around 70, almost 80 in 2014. That's the average cost of production. Don't underestimate technology and horizontal drilling and fracking and all those things. And I like to point out is rig counts are about the same as 2010, but since then, total liquid fuel production's increased well over 100%. So that's called a paradigm shift. In the meantime, though, what's significant, though, Kai, is crude oil, liquid fuel, crude oil demand peaked in the U.S. And now, if you look at since pre-COVID, U.S. unleaded gas demand in the U.S. is down about 5% from pre-COVID. And total EV sales, was that portion of passenger vehicles, is jumped up to around 15%. That's from Bloomberg New Energy Finance. It was about 3% before COVID. So these are things that we wrote about. It's completely predictable. When you get a war like this from bad guys, like when Vladimir Putin invaded Ukraine, And just like when Saddam Hussein invaded Kuwait, you typically, and it'll accelerate existing trends. That is, get me away from fossil fuels. And you can do it cost effectively, according to Jeff Booth's Price of Tomorrow. So that to me is accelerated and it's happening. I drive an electric car. I've got some electric bikes. And man, the technology is awesome. And my car is 10 years old, my EV.
10 years old. What are you driving? So one of the Tesla Roadster?
No, I have a poor man's Tesla. I have a Chevy Volt, which is a plug-in hybrid. Yeah. And after this interview, I'll be driving it like 4 or 5 hours. And you know, it's a plug-in hybrid is perfect because it goes to gas when you hit the highway, but normal driving, it's electric.
Yeah. Oh, fantastic. Okay, Mike, we've drawn quite a doomy and gloomy scenario, and let's look at the bright side here, because some sector has to benefit from all we're talking about, and I hope personally that you're going to be talking about gold here a little bit, and maybe some of the precious metals that might benefit from this. But I'm curious, like to quote Jim Cramer here, there's always a bull market somewhere, right? So on the flip side of our discussion now, where would you maybe be personally investing, or where do you see an uptick in activity, or where would it be worth looking at?
So I think gold and U.S. Treasury long bonds will be some of the best performing assets. I've been way early on long bonds. I did not think the Fed had hiked this much. I did not think long bonds would get to 5%, but now that they have, I think they're going to drop towards 3 or lower. It's a question of time. Gold, I think, is going to meet with the S&P 500, maybe around 3,000. Now, here's just a matter of time gold breaks out in terms of the dollars. Just number one factor about gold is it beats virtually every commodity over time, particularly if it's a total return, if you're holding it versus, you know, holding a chemical or holding like a soybean or crude oil. But especially in recessions. So I like to overlay the per ounce price of gold with the S&P 500 since the U.S. came off the gold standard in 1971. It's a cat and mouse game. And virtually every time gold is this low, the S&P 500, you hit for a recession, it just reverts up to the price of and they revert towards the other. So I think they're going to meet around 3,000. It's a question of time, in my view. But you need part of that catalyst is you have to have the stock market go down, tilt towards a deflationary recession, have the Fed eventually pivot, and gold benefits. But just don't forget, remember 2008, gold went from 1,000 to 700, and that was what set the rally from, that 30% decline set that rally up to 1,900 an ounce. So it's not going to be easy, but those are some of the assets I think will perform best in this recession. Here's the way I look at it also simplistically, Kai. If 2 years from now you say, hey, McGlone, you know, I have most of my assets in U.S. Treasury 2 notes and I only made 10%, and all my friends made 20% in the stock market, I'll say, yes, I'll be delighted that happened. It means we got through this most significant period in history. We're way overdue for reversion in risk assets, reversion in markets, and you only made 10%. Darn, that's the difference. You have that alternative now.
And I think that's where it's headed. Like personally, like I've been looking at the 10-year bond yield as well. It's whenever there's a bit of activity, you know, the 10-year drops. Like we've seen over the weekend, again, the 10-year dropped to 4.6 from 4.8, 4.9 almost. And that's where some of the safe haven investing and the dollar went, or the dollars flooded to, right? Talking about the dollar, maybe we haven't touched on the dollar itself yet. Where do you see the currency heading, the DXY and the currency itself?
The thing I like to point out about the dollar is right now, it is an unstoppable force that's breaking things, and it's going to go down. What's going to take it to go down will probably mean lose-lose for all risk assets. At 5.5% Fed funds, compared to the other top 3 countries on the planet, China, Germany, Japan, it's many X's. They're 2-year note yields. I mean, and there's base rates. So that's just a force, and you've seen it now. Their currencies are melting, and they have to, maybe not euro, but they have to support their currency. Certainly Japan and China. The key thing to remember about the dollar is not only is it the highest rates in the world, but money supply is negative in this country. But it's that direct, almost tick-for-tick connection with the U.S. dollar on a broad trade-weighted basis. You mentioned the DXY versus the U.S. stock market. If you take the U.S. stock market divided by the rest of the world, it's been outperforming so much, complete correlation with the dollar. So here's my risk reward standpoint. For the U.S. stock market needs to go down for the dollar to go down. U.S. rates need to go down for the dollar to go down. Eventually, it's going to happen. But what does that take with it? And how can that happen without that? How can the dollar go down without that? That, to me, is the key risk. Is Gina Martin Adams, she's our chief equity strategist. She showed me that correlation between the dollar and the S&P 500 versus the MSCI ex-US. So here's the scenario I'm looking for: is U.S. stock market goes down, eventually U.S. yields rates follow, dollar has some weakness, or you have something break. But until that happens, also usually when there's something happening globally, the dollar has strengthening problems, particularly when there's wars going on. I think everybody's realizing the world, do you want to be on the side of Xi and Putin and people are attacking Israel, or do you want to be on the side of, U.S. is not perfect, but at least he provides safety and open seas, and people in French don't play baseball for a reason.
Yeah, we don't. Like your Germans don't either. Not really.
Exactly.
Not really.
The Japanese like it though. We like that. Great,
Yeah.
great. They have some great base players.
Although American football is gaining a lot of attention over here in Europe, so especially Germany, it's which is interesting.
Football in France, it was just low level, but it was fun. It was decades ago.
Amazing, Mike. I think we've touched on all the topics I want to run through with you. Like we touched on commodities, your recessionary scenarios. We talked U.S. dollar at the end, crude prices. I really appreciate your time. It was fantastic speaking with you. Let's do this again very soon, maybe early Q1 next year, and to see where we're at. Really looking forward to your oil report coming out here in the coming days. Probably going to be out before this interview airs, and can't wait to speak to you again. Thanks so much for your time.
Thank you, Kai. Some of that will be on LinkedIn and Twitter this weekend, so people will be able to read it, and the headline will be Facts and Fantasies. I wrote it last year, and I had to rewrite it this year. When everybody was so bullish, I had to point out the facts of most crude oil traders get it. You don't want to ever be long crude oil after it pumps like the velocity did 2022. It's its own wrecking ball.
Fantastic. Mike, do you quickly share with us your handle on Twitter?
Yes, Mike McGlone, at Mike McGlone 11.
Fantastic. Awesome. Mike, thank you so much for your time. And everybody else, thank you so much for tuning in. We hope you enjoyed this discussion, because I sure did. It was really informative. Make sure to follow Mike on Twitter. There are lots of good commentary as well. And leave a comment. What do you think is going to happen? Are we going to see $40 gold? Really curious. Not $40 gold, $40 oil. Is that happening? Let me know what you think. When are we heading in a recession, and how are you protecting yourself? Let us know. Leave a comment. Hit that like button. And if you haven't done so, smash that subscribe button, because I know 80 to 85% of you watching are not subscribed yet. Kindly change that. I really appreciate it, because we can bring guests like Mike on the program more often, and just build a better audience. Thank you so much for tuning in. We'll be back with lots more.